Hello, good people. This is Karaja James again. I got a question from one of my viewers. He wanted to understand the difference between these three companies. Number one, a joint venture, which we call a JV, a venture capital company, which we call a VC, and a capital companies, a JV, a VC, and a capital company. So you understand, if you are in business, you are going to hear these words that I am in a joint venture business. I am in a venture capitalist business or venture capital business. Or I have a company that is a capital company. So what's the difference between these three companies? So we are going to start with the definition. Definition of a JV, a joint venture. This is where two parties come together for a decent goal. They set a goal. In real estate, you're going to hear this so much because you find one party has something where the other party has another thing that they don't have and they need it. So you find that I have the plot, a parcel of land, but I don't have the money. And another company which deals with JV, joint venture, they have the money, but they don't have the land, but they want to invest in real estate. So they come, we agree, we are going to build this house for you at this cost. It's going to cost this money, and we are going to pay ourselves in the next 10 to 20 years, taking rent from that house. That's a joint venture. A VC, a venture capital business, is where I have a company that has high value, high growth potential, but I don't have the money to get people inside. I don't have the money to look for customers. I don't have the money for marketing. So I'm going to look for a venture capitalist, either an individual or a firm, to invest in my business for equity, for a certain value of my business in the long run. And a capital business, this is where I, as an investor, I have the money. I don't know what to do with it because I don't want to make a lot of risk without the knowledge or without the people who knows how to invest. So I take my 2 million Kenyan shillings, I go and give a capital company to invest on my behalf, to invest as they know how best for me to get profits or interest. That's the difference by definition. Number two, those people who participate in a JV, they can be two or more, but after a certain task. When that task is completed, that JV is done. You get your money back, you get your interest, you get your profit, you give me back my thing that you created, and I manage it for a certain time. But a JV, this is an individual or a firm that is trying to invest in early stages of a company or a startups. It said out of 100, more than 40% of the startup companies fail. But you find that in those companies which are failing, we have those who have high potential. And if I'm a joint venture capitalist, I'm going to invest in those companies for an equity for 30%. And if you are a business oriented, you have come across with Lions Den, those companies, Lions Den, Shark Tank, they are there to invest in actual innovations, new ways of doing things. So that's a participation. Number three, and capital business, this is where I, as an investor, I take the money, I give it to you for an interest, for a percentage. So I can have this company, I know how to invest in real estate, I know how to invest in innovations, I know how to invest in construction, I know how to invest in building houses, I know to invest how, but I don't have the money. So I'm going to the public and ask for money for a certain percentage. And these capital businesses, most of them are capital companies, you find them, they are trading in the Nairobi Stock Exchange, because when they reach a certain place, a certain level, a certain margin, they go and ask for more company or for more money from the from people, so that they can invest and grow as they want to, as their goals, you know. So number 3, the purpose of JV is to share resources. That's the genuine purpose of having a joint venture. We share resources, me and you. But in JV, a joint venture, this is where people share, provide funds to a growth of a business for equity. Well, a capital company, this is where the company doesn't have the capital, they want the capital from me, so I give them capital, they convert it into interest and profits. Number 4, all these companies are in the business of risk, because when you joint venture, there is risk to be taken. When you're in a BC, the person investing in a startup is going through risk management. He has to invest in you. And in the person who's investing in a capital market or capital company, you are going also to have a risk, because you don't know what these people are going to invest in. Even though they have the knowledge, they have the structure, they have everything, you don't know if you are going to get back your money back, because you have had so many companies falling from Nairobi Stock Exchange, the World Stock Exchange, London Stock Exchange. Companies fall, and there are people who are invested, so it's a risk. Profits are shared in a joint venture for a certain period of time after completion of a goal. That's when the profits are shared. You can have an agreement, a contract. I'm going to be taking this money, you're going to give me my investment, this. So there must be a contract. In a joint venture, this is where you get equity, a certain percentage of a company. And if you cannot understand very good in JV, go and look for Shark Tank. It's an episode that is done. Look for Alliance Den that was done in South Africa. I think in our place Kenya it also was done. Go and understand how to invest in startups. You get the introduction, you get what they are doing, you look for the projection according to your path of knowledge, and then you invest in that startup. And profits in a capital business, you get the interest, you get the profits, you shared to a certain amount or what you agreed. So all business are in for risk and profits. So duration of these companies, I can say joint venture, it's for a duration of time, but a VC, venture capital, is where you invest an equity, because we say a business has a foreseeable future. So it's for the future, it's long term. The same case with capital, there is constraints with capital companies, but it's also a long term. It's a long term where you determine, I'm going to give this money, is going to what you call portfolios. You invest in the portfolios. If you don't understand what portfolio is, you can also Google, you can understand later, or look for videos about portfolios. And legally, the contract in JV comes to a close when you have completed the goal. But in a VC, you have the equity which is a foreseeable future. You know, as long as the company is pursuing is open door, so you're in a VC. And a capital, you have to manage the investment for you. The person who owns a capital company invests legally your money for you for interest and profits. So I hope I've answered your question. See you in the next video.